Okay, let's just get right into it. The charts are a sea of red, and pretty much every crypto investor out there is asking the exact same question. Is the bull run over? Let's break down what is actually happening.
So this is the big fear, isn't it? Bitcoin just took a nosedive, briefly punching below $75,000. And that level, that was supposed to be our solid floor. But what's really concerning isn't just a quick flash crash. It's this slow, painful bleed we're seeing. And for the bulls, that's way, way more worrying. We're going to get into exactly why.
First up, let's just put a number on the damage. Bitcoin closed out January down nearly 11%. And to be crystal clear, this wasn't just a bad month. It was a historically bad month.
That's right. You have to go all the way back to the darkest days of the 2018 bear market to find a January this bad for Bitcoin. So this isn't just some little dip. This is a real signal that the entire feel of the market might be changing. So what caused it?
So, what was the trigger for this latest leg down? Well, the answer isn't actually in the crypto world itself. It's coming from the bigger picture, the macro environment. And it comes straight out of the White House. To really get this, you have to remember a kind of golden rule in crypto. A strong US dollar usually means a weak Bitcoin. Why? Well, think about it. A strong dollar means the Fed is probably going to keep interest rates high, which makes holding dollars feel safer for big money. And that's exactly why President Trump's nomination of Kevin Warsh for Fed chair sent such a shockwave. The market sees Warsh as a hawk, someone who likes policies that make the dollar stronger. And that sent investors scrambling away from riskier things, like Bitcoin. And here's what that looks like in real time. We're seeing a full-blown capital rotation. Money is flying out of digital assets. And where's it going? Investors are either parking it in the US dollar for safety, or they're chasing these insane returns we're seeing in tech and AI stocks. Right now, Bitcoin is just losing that fight for attention.
Okay, so that's the big picture stuff. Now let's zoom right in. Let's get down to the charts and see the actual price levels where this war is being fought. Right now. This is the battleground. All right, these are the only two numbers you really need to care about right now. $75,000. That is the absolute line in the sand. The bulls managed to defend it for a minute, but if we see a daily candle close below it, whoosh, the door to 70K or even lower swings wide open. And then, looking up, that $82,000 level that used to be our support, it's now a giant brick wall of resistance. So here's the key takeaway on strategy: patience. If you're a bear, you are just waiting for any bounce into that $80,000 to $82,000 zone to fail. That's your signal. And if you're a bull, this is not the time to be a hero. You wait. You either wait for the price to get back above 82,000 with conviction, or you wait for a really clear bottom to form at 75. The trend is your friend. And right now, the trend is down. You do not try to catch a falling knife. Now, I want to shift gears a little and look back at history because what's happening right now, it's giving a lot of longtime analysts a serious case of déjà vu. It feels eerily familiar. This is the warning shot that's starting to pop up from some pretty major analysts. They're looking at the shrinking volume, they're seeing the big institutional interest kind of fade away, and it's reminding them of that period right after the 2017 peak. The theory is that Bitcoin might be entering a long gap year, just a period of grinding sideways, building a base, not shooting for the moon. I want you to think back to 2018. The party just stopped. The easy money was gone, and all the tourists who showed up for quick gains, they vanished. That was the start of a long, brutal, grinding bear market. And in those markets, wealth gets transferred from the impatient to the patient. Now look at today. Sound familiar? Institutional volume is dropping off, retail investors are spooked, and the overall trend has clearly shifted downwards. This is, by definition, a grinder market. It's a market that rewards patient buying over wild speculation. So, let's wrap this all up. What does this actually mean for your strategy as we get deeper into what looks like a very uncertain year? If there's only one thing you take away from all this, please let it be this. The easy mode is over. The conditions that created that incredible run-up, they've changed. The macro environment is tough, the charts are broken, and that speculative favor has definitely cooled off. Look, in a market like this, playing defense is just as important as playing offense. Your number one job is protecting your capital. And please, remember, sitting in cash and just waiting for a better pitch, that is a valid and often very, very profitable strategy. So I'm going to leave you with this final question to think about. Right now, the bulls are defending $75,000 like their lives depend on it. But if that line breaks, well, there's not a whole lot of support until we get down to the $60,000 range. So what do you think happens next?